How is everybody doing? Thanks for being here as always. This is Bob Iacchino from Path Trading Partners. Notice up here we have no logo because this is not about us. This is about you guys. This is Moneyness in the Greeks Part 3. If you have not seen the other webinars about binaries and moneyness in the Greeks, please go to nadex.com/ well, it's an education tab. It's a webinars tab that they have. So you go to the webinars tab and look in the archives there. Go down to it's education, trading webinars, and then you go into archived, which will be below the Nadex webinar schedule. You'll see this month upcoming in archives, or archived rather, and you'll be able to see the first 3 there. We always recommend that people see the first 3, but we're going to go ahead with this anyway. This is being recorded and it'll be up as well. Mike Arnold is here with me, and before I begin, as always, you guys know by now, if you're new, we take risk very seriously, and therefore we take our risk statement very seriously. So please, this is not like the safety thing in the plane where you just kind of continue to read your magazine. I actually want you to pay attention to this if you could. This presentation is for information purposes only and does not constitute investment advice nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes, but only for use as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of future results. Very serious thing, not just read to cover our butts. You actually have to. Nadex goes halfway there for you by giving you these risk control products, but you really need to be careful the amount of money you put at risk. Okay, it's always money that you can afford to lose. It is called risk capital for a reason, because it's money you can afford to risk. It's capital you can afford to risk. So please take these risk statements seriously and understand what they're saying. Path Trading Partners is a trading and education firm. If you don't know who we are, our mission was to form a trading firm that educates, supports, and backs traders who are committed to probabilities, discipline, and long-term trading success. We are a seeding company, a trading company, and an education company. This is achieved by following the correct path. We are not high-frequency traders, and we are not day traders. What we are is a firm that believes in a long-term success in trading, covering time frames dictated to us by products, markets, and price action. If you're a sports fan, you've heard, take what the defense gives us. Okay, if you're batting against a left-handed pitcher, you try and line it up with righties. If you're batting against a right-handed pitcher, you try and line up with left-handed hitters. You go with the probabilities. You don't just try to force something down the market's throat because you'll lose. Mike Arnold is a 23-plus year market veteran, and he's been teaching traders online and in person for 10-plus years. He was and still is a development consultant to multiple hedge funds. I've mentioned this before, but again, if you're new, when Mike gets contracted by a hedge fund, his job is to break their system. They find systems, they build systems that they think work, and then they call Mike in and say, where's the issue with our system? What's wrong with it? He finds that. He's a former options market maker on multiple exchanges, and he has traded in Chicago, New York, Switzerland, and Canada. He is the current head of technology and trading system development for Path Trading Partners, as well as my co-founder. I am that Shrek-looking guy in the pink shirt at the top right. I've spent the last 23 years in the commodities, futures, and forex markets, actually almost 24 now. I've been teaching and mentoring traders both live and online since about 2002. I have been an analyst, a prop trader, a fund-to-funds hedge fund principal, and a member of that investment committee. And I've taught and mentored over 5,000 students so far. It's funny because I always mention Mike's, I'm specific about Mike's role as a consultant to hedge funds. My role as a member of that investment committee at the fund of funds is where I help you guys, because my job was emerging traders, emerging managers, examining their track records and trying to find which ones were good and which ones were bad. I have appeared and still appear on really all of the major networks. I've done over 700 interviews, that's probably over 800 by now, on various topics, and I continue to appear about 5 to 10 times per month. I've been on Futures Now a bunch, gotten a lot of attention for that, and I am on Bloomberg Television tomorrow morning at, I don't remember if it's 7:10 or 8:10. I think it's 7:10. I'm not sure. I'm on Bloomberg tomorrow morning, that's all. So, I don't really have to talk about myself too much, so let's move on to what we did in the last session. In the last session, we introduced the Greeks, okay? And we went in depth into the concepts of delta and gamma. We examined how the delta of a binary option affects the price of the binary option as the value of the Nadex indicative index moves up and down. We then looked at the concept of gamma and how gamma affects the delta of the binary options as the value of the Nadex indicative index moves. You have to understand the Greeks to trade options, and binary options are options. In this session, we're going to continue to take a deep dive into the concept of the Greeks and how they are applied to Nadex binary options. We're going to do a very quick recap of delta and gamma in case you haven't watched those prior webinars. Again, you can see those prior webinars at nadex.com/tradingacademy/webinars. Then we'll be examining the concept of Theta and Vega. Now be patient because it may take a couple of times reviewing it for it to sink in. But you will have that light bulb moment. That light bulb moment comes at different times for different people. So if you're trading with a buddy and your buddy gets it and you don't feel bad. It takes time, but it will come. With these kind of things, there's really no substitution for time in the chair and understanding the relationships, watching the relationships play out. We're going to come out with some tools soon that'll help you with the relationships a little bit. But for now, it's just better that you understand what it is we're talking about as opposed to what the actual numbers are. So let's look at what the binary option Greeks are. We can apply these Greeks to Nadex binary options, and the definition of each Greek is as follows. Delta is the sensitivity of the Nadex binary option price to value changes of the Nadex indicative index. Gamma is the sensitivity of the delta to the value changes of the Nadex indicative index. Theta is the sensitivity of the Nadex binary options price to the passage of time. That's right, you may have noticed it and not understood why, but as your Nadex binary option sits, time decay will take place. Time will start to affect the price. Vega is the sensitivity of the Nadex binary option price to changes in the implied volatility of the Nadex indicative index. Again, you don't have to know what the implied volatility actually is, you just have to recognize when it's changing, and we're going to show you that. And then rho is the sensitivity of the binary option price to changes in the interest rate. We will not be looking at rho, since when we are trading Nadex binary options, it's on a short-term basis, and rho will not affect the price of Nadex binary options the majority of the time. You don't see interest rate changes every single day that you're trading a daily or an hourly expiration. It just doesn't affect it enough to even concern yourself with it. Now, we have to talk about some of the pricing model limitations. We talked about that in the last webinar, and we'll review it here again. Some of the assumptions that option pricing models make are as follows. The direction of the underlying, which would be represented by the Nadex indicative index, cannot be predicted consistently. The price of the underlying is log normally distributed, which it's not. The underlying price in any time period depends only on the price observed in the preceding period. We know that that's not always true. As a matter of fact, well, I don't want to say it's hardly ever true, but that's not always true, but that assumption is made. Traders are risk neutral and indifferent towards risk. We hope that that's not true. Okay, we at Path Trading Partners try to drill it into your heads that that shouldn't be true. You should not be indifferent towards risk. But again, the assumption has to be made for the models to play out. And also commissions and fees are ignored. There's multiple levels of commissions and fees with different options at different exchanges. So the commissions and fees have to be ignored. So in the following slides, we are modeling different aspects of the Greeks. The price movement and values will be exaggerated to clearly show examples and help clarify the material. Remember, focus just on the concept and not the absolute values, which will be based upon implied volatility for the Nadex indicative index, which varies hour to hour and day to day. When Mike goes through these slides with you, I know that it's going to pop in your head, well, how do we know if the implied volatility is 20? That's not really important. It's more important that you grasp the concepts. So let me go ahead and turn it over to Mike, and he can continue with the slides for you.
Great, thanks Bob for the great introduction. So, before we get into the material this week, we're just going to take a quick look at, to recap some of the stuff we did last week. So here's a curve of the delta, and the delta models how the binary price changes at a specific strike with a specific timed expiration and a specific implied volatility. So if your underlying moves 1 point and your delta in this case would be 14, the option price would change, the binary option price would change by $14. If it moves 1 point and its value is 5, it would change by 5. Now this is for a 2010 strike binary option, and the scale down here is where the indicative index or the underlying would be trading. So as you see, this is the strike price is pinned. We're only looking at one strike price, and the variable we're changing on this slide is where the underlying is. So as you see, as it approaches at the money, the delta is the highest. As it goes further in the money, the delta drops, and it goes from out of the money towards at the money, the delta increases. Again, this is with a specific timed expiration, which you'll see at the bottom of these slides, and this is also with a specific implied volatility, which is not listed on this slide. So that's your basic overview of delta. One of the key components we touched on last week, and if you need to review this, I'll just recap it briefly here, but things change. The delta changes as time changes. So as time goes in this slide on the left from 60 minutes down to 1 minute, you can see if the underlying stays, let's say, the same, like at the money, 2010, your delta actually gets more and more and more as time gets closer and closer to expiration. Well, we talk about implied volatility. On this slide on the right, you notice how it looks very similar to the slide on the left. Well, implied volatility, as we covered, and time generally have the same effect on the option pricing model. Lower volatility is similar to less time. All right, higher volatility is similar to more time remaining until expiration. So for the 2010 strike price at the money, you can see as volatility goes down, the delta increases. As volatility goes up, the delta decreases. All right, and this would be with a specific timed expiration. This is, the slide on the left is with fixed implied volatility, meaning the only variable I'm changing is time. The slide on the right is with a fixed time. The only variable I'm changing is implied volatility. One of the things I want you to remember is time is very similar to volatility in the fact that more time is similar to more volatility, less time is similar to lower implied volatility. Here's the curve of gamma. Gamma is the rate of change of the delta, and remember, delta is the rate of change of the price of the binary option. So gamma is your second derivative. It is modeling how the delta changes. That's why you don't have a straight line delta curve. It has that horseshoe shaped. That's because the gamma looks like this. It's easier to look at. Again, here's our delta curve on the left. Here's our gamma curve on the right, both with 15 minutes to expiration and with the same implied volatility. So you see, we curve up. We have a positive gamma. That means as the underlying is moving up, we're actually adding to the delta. Now you notice how this slope increases. That's due to the increase in gamma. Then the slope actually is still going up but doesn't move up as fast. That's because you see your gamma is still positive, okay, but not as much. So that's where this slope sort of rounds out. gamma turns negative, that's how your delta starts dropping until you get all the way back down to 0. So that's sort of your side-by-side delta and gamma comparison. To reiterate my point from before, volatility and time compared, lower volatility, lower time, curves look the same. Higher volatility, higher time, they're sort of lost in this mist. It's easier to see, all right, if we go to 10%, look, the curves look the same. As we go down to 1 minute or 5%, the curves look the same. So you can see how less time and lowered implied volatility have the same effects on both your gamma and delta curves. That's your brief recap. Now for the new stuff in this webinar, we're going to be getting into Theta and Vega. Two of the easiest and most useful Greeks to understand are Theta and Vega. Theta models how a Nadex binary option price will react in regards to changes over time. Vega models how the Nadex binary option price will react in regards to changes in the implied volatility of the Nadex indicative index. Remember, time and implied volatility are both inputs to a binary option model, as well as your underlying price or indicative index price, and as well as Bob covered, there's things like the interest rates, the risk-free interest rates, etc., which we're not really going to worry about in this presentation. So here's just price versus time of a 2010 strike binary option. And again, don't get hung up on the strike price or the underlying price. Just notice at the range. If this was a, let's say this was a $50 crude strike price binary option, the curves are going to look the same, you know, as we're $50 at the money. You know, this could be the US 500 based off the S&P 500. So that's just the curves are going to look the same for regardless of the market you're trading. That's why we also taught the concept of at the money, in the money, and out of the money, so you can always have those reference points. All right. So we have a fixed implied volatility, and the bottom scale shows the changes in price as the time approaches expiration. Well, at expiration, we know if it expires at 2010, and it's a 2010 strike price binary option, and you are long this, it would be worth 0. Anywhere below, at or below 2010. 2010, above 2010 on expiration, this would be worth 100. So it would jump all the way up there. However, at different times to expiration, you'll notice how the curves change. Like with 60 minutes to go, if we were long this 2010 strike binary option, and let's say we bought it when it was at 2006. The underlying is 2006. We could go up here and say, roughly, based off this implied volatility, you know, this is going to be worth maybe $25, let's say, somewhere around there. If the underlying trades up and down, and it's trading in 2006 with only 30 minutes to go, that same option we own will now be worth maybe $17. If it trades up and down, again, we come in and check in it with 15 minutes to go, it might be worth $10. Well, what's changing? Time's changing. This shows you how time is decaying, and time decay affects, when you're long and it's out of the money, affects you negatively. It takes away from the value of the option. If we're in the money, let's take a look at the example up here. Let's say it's trading around 2012 and we're long this option. Could be worth, maybe with 60 minutes to go, about $65. We check back in, and we're still looking at 30 minutes to go. If it's still trading around that same level, right here around 2012, maybe it's worth closer to $70. We check back in, still trading around that 2012 level. With 15 minutes to go, it's now worth maybe $75. 5 minutes to go, it's jumping up all the way to $90. So you see how if you're long and it's in the money, the passage of time is helping you. So we have to look at how this time decay affects not only where you are out of the money, at the money, or in the money, but Does it react linearly? Does it accelerate when it's closer to expiration? Those are the things we're really going to be looking at right now. The prior slide is a clear example of the concept of theta. Here's the definition of theta again. Theta is the sensitivity of the Nadex binary option price to the passage of time. Time always decreases. Again, time always approaches expiration. You can never add minutes back on the clock when you're trading these things. Therefore, theta is the only unidirectional Greek. Theta can both help and hurt the Nadex binary option trader depending on whether the position is in the money or out of the money, and depending on whether you're long it or short it. Here's how it looks. Here's how the theta curve looks, with a specific implied volatility and with 15 minutes to go for a 2010 strike binary option. Let me go back here real quick at this other slide. You see when it's at the money, no matter how much time to go, the option's worth roughly $50. Okay? Why is that? It doesn't change until the very end when it expires. Well, look at the theta at 2010. It's 0. So the passage of time does not affect the binary price until the very, very end when it's at the money. But remember how we talked about, we were down here 2006 or 2007, and every minute that passed hurt. If we were long, it decreased the value of that option. See, theta is negative down here. So that means every minute that passes, your binary option decreases in value. Remember when we were looking at we're talking about, hey, maybe I'm long it at 2012, and every minute that passes is actually increasing in value. That's because our theta is positive up here. So the passage of time helps us if we are long and in the money, and if we are long and out of the money, it hurts us, and it has no real effect until immediately at expiration if it's right at the money. Here's side by side the 2010 strike price binary option graph and the theta. So again, you can see how when the theta is negative, all the time that passes changes the price and reduces the price. So anywhere down here until it gets to 0, the passage of time slowly eats away at the price of the option when it's out of the money. When it's in the money, you can see it's positive up here. It slowly adds to the value of the option over time. So if the underlying stays at the same price, and the only thing that and implied volatility stays at the same price, and the only thing that changes is time, and the position is in the money, depending on how far it is in the money, will determine how much the binary option increases with every minute that passes. Again, this is not linear. Okay, just because it's in the money, it does not change at the same value with every minute that passes. For example, at 2011, it adds, and this is based off of a certain amount of time passing. Well, let's just say every minute that changes, it's going to add a value of theta of 6. Versus if you were at 2012 with the underlying, it would add a value of 10. All right, to that option. We will have to move the decimal point, so this would be about 5 cents with every minute that passes. This would be about 10 cents with every minute that passes. What I'm trying to show you is that you can't say just because it's in the money, the theta adds to the same value. Just as when you're out of the money, it does not subtract from it depends on where the underlying is trading to the amount of the time decay. In the prior slide, we saw how theta can help the trader when Nadex binary option is in the money if you're long it, and it will hurt the trader when the Nadex binary option is out of the money if you're long it. The opposite is true if you're short the binary. Theta becomes very significant when the binary is at the money and close to expiration. Okay, theta versus time. When we're really close to at the money, close to expiration, look at how the theta reacts if we're slightly in or out of the money. If we're slightly in the money, this is where you're going into the last couple minutes of trading. the time decay really kicks in, because this is how it gets to that, if you're if it's in the money, it gets that $100 value. It really starts adding to it close to expiration. You see, when you're really far away from expiration, time doesn't really affect the price that much. It affects it a little, but not that much. As you get closer and closer to expiration and you're close to at the money, so this is at the money, this is slightly in the money, it really starts spiking up. This is slightly out of the money. It really starts decreasing the value rapidly, because if it remains out of the money, this option is going to be worth 0 upon expiration. So that's how your theta curve changes over time. Theta really accelerates very close to expiration, especially when you are close to at the money, on either side of at the money. Now, volatility also changes the impact of theta. So you can see how, if we change the implied volatility in the option market maker's model from 40% to 5%, it changes the way the curve looks. All right? And it drastically changes, and this was a specific time expiration, but it really starts affecting it at different points of the curve. And this is more of a complex diagram to try to memorize, so don't attempt to do that. Just know that, sort of remember lower volatilities, remember with lower time, it's going to affect it when it's really close to at the money. Here's our time example again, and see how it really starts spiking when it's low and you're close to at the money. The same thing happens here. When it starts going down to a certain extent and you're close to at the money, it has a lot more effect. When you go up and up and up in implied volatility, it actually shifts the effects out further away, for either further out of the money or further in the money. The effects of volatility changes. Here you can somewhat see the time and volatility graph side by side. The time is a little more amplified due to the nature of time close to expiration, but you can see how it still looks somewhat similar. That's how we're just keep in mind that time and implied volatility are generally the same for these option models. Let's get into Vega. So Vega's the implied volatility, and implied volatility is based off not only the current underlying volatility, so if the market is more volatile and moving around more, you'll have a higher underlying volatility. But also implied volatility is based off the future expectations of whether that implied volatility, or whether the volatility is going to go up or down. That's why it's called implied volatility. So even if volatility is high, but maybe it's going to go into a quiet trading time of the market, the market makers can start reducing the implied volatility of the option model, thereby changing the price of the options. The definition of Vega is the sensitivity of the Nadex binary option price to changes in the implied volatility of the Nadex indicative index. So we're now fixing the time with our 2010 strike binary option, and we're only changing the implied volatility. So if we're trading this out of the money, let's say down around this 2000, maybe around 2007, and implied volatility is at 40, this binary option would be worth about $30. If the implied volatility, we're holding time constant, were to change to 30%, the option's only worth $20 theoretically. If it went down to 20%, the option's only theoretically worth $10. And with really low volatility, that option would be worth next to nothing. So you can see how just changing the volatility changes the price, the theoretical price of the binary option. Let's look at it at the money. It really doesn't change it. Remember how time didn't really change it until the very end? Well, when you're at the money, volatility doesn't change it either. Okay? Now we go into the money. Let's say we're trading at 2012. So your underlying is trading at 2012. If the implied volatility in the model is 40%, maybe the option's worth, let's call it $65. If it drops to 30%, maybe it's worth $70 approximately. We drop it to 20%, it's now worth $80. We drop it to 10%, it's now worth maybe $95. We drop to 5%, it's nearly worth its full theoretical $100. So the only thing changing here is the implied volatility. Time's not changing. We're looking at a specific underlying price and a specific pin strike price binary option. Here's what the curve of Vega looks like. So this is where it's out of the money, it's positive, and it goes more and more positive, and at some point it drops off. At the money is 0. As you get in the money, it goes negative. And then as it gets further and further in the money, it goes back towards 0. What does that mean? Well, the prior slide is a clear example of the concept of Vega. Vega can both help and hurt the Nadex binary option trader depending on if the binary option is in the money or out of the money and if you're long or short it. Let's look at this side by side. It's easier to see. Here we have this graph we looked at a couple slides ago with the only thing that's changing is applied volatility. This would be out of the money, this would be in the money. So you see here, curve is positive. Let's take a look where it's maximum positive. This was 15 minutes to go. 2007. So what this is saying is as our implied volatility goes up, it's adding to the value of the option. So you see, let's really take a look at 2007. Let's say it's started 10%. It's theoretically worth near 0 because there's not enough volatility. The odds of it getting in the money are very low, so that's why your option is priced so cheaply with low volatilities. But then we go up, let's say, to 20%. Now your option is worth $10. We go up to 30%. We're adding, for every 1 point increase, we're adding nearly $1. So we go up to 30% volatility. You know, our options may be worth $30. And as we keep going up, it's going to keep adding more and more to this. Now, if we're in the money, look what happens. Let's say we're in the money at 2012 and volatility is at 10%. Now, the underline's not moving, but let's say volatility then all of a sudden spikes to 40%. See, that's going to have a negative effect on the price of the option. That's why this curve drops. You're now, as it goes up, subtracting from the price model. So what was maybe worth 95 drops to maybe 63, just because the increase of implied volatility option. So if you are in the money and all of a sudden implied volatility in the option starts going up, up, and up, and nothing else is changing, I mean, it theoretically could be trading back and forth a bit, but maybe it's going into a huge report announcement and price is not really moving yet, but the option market makers are jacking up the implied volatility. You're long this thing, it can actually reduce the value of the binary option you're long. Keep that in mind. So it can actually hurt you if then you were to get out of this position early and not hold it to expiration. Versus if implied volatility is going on and the only thing that's changing is the implied volatility, it's going to increase the value of that option, and that could hurt you help you if you're long it. It would hurt you if you're short it. It could help you if you're long it. So, real quick, we just had a quick question. So it's best to get out early in that case. It depends on it depends on a lot of things. It depends also on the timed expiration, whether that volatility, the implied volatility, actually translates into actual volatility, what you expect, you know, what your sort of trade model showing you. But yes, if you start seeing, you know, implied volatility go up, up, and up, and you're planning on getting out early because you think this thing could go out, if you think this thing could go out of the money and you're seeing implied volatility go up, up, and up, yes, it might be wise to exit early. But all these factors have to come into play. So it has to come into play with your sort of market expectations. What I'm showing people, though, is sometimes they see things going on in the binary options. Oh, I'm long it, and the price really isn't moving, but why is that option decreasing in value? They don't get it. Well, now you do get it. You know that if that implied volatility is going up, nothing else can change, okay? Now, time's always going to change. That's why we covered time first. But if that implied volatility starts changing rapidly, that price, the bid offer spread, are going to change on that option, and it could go against you. It could also go for you. But people go, why is that changing? I don't see the underlying sitting at the same place, and I don't really understand why that binary option price is changing. Well, now you do. It's a change in the implied volatility of the model they're using. So, in the prior slide, we can see how an increase in implied volatility helps the trader who is long a Nadex binary option that is out of the money. If it's just an increase in implied volatility, it's going to help you. It doesn't mean, though, remember, if it remains out of that money, out of the money, and it hit its expiration, it didn't help you. It helped you in the short term because it increased the value of the option. But again, you have to consider, am I holding it to expiration? All right, and if I do hold it to expiration, it remains out of the money. It didn't really help you because it'll still expire worthless. Conversely, an increase in implied volatility hurts the trader who is long the Nadex binary option that is in the money. Again, it only hurts you in the short term. If you're planning on holding it to expiration and it remains in the money, it will still expire worth that full value. But if you need to get out early, you can see that option moving against you if implied volatility is going up. Now, the opposite is true if implied volatility is decreasing, so you have to judge the conditions. Is implied volatility going up or down? Am I in the money or out of the money? Am I long or short? And am I holding it am I planning on holding it to expiration or not? Now, the opposite is also true if the trader has a short Nadex binary option position. That's why you might have to watch this presentation a couple times to really let it sink in, because it matters if you're long or short, if you're holding it to or planning on holding it to expiration, if implied volatility is rising or falling, and if you're in the money, at the money, or out of the money, and how far in the money or how far out of the money you are. There's a lot of these components, and I'm showing you a lot of moving parts, but at least now you can start understanding what's truly going on in the pricing model, and that it's not as simple as, is it worth 0 or 100? Other things can change and change the value prior to expiration of this binary option. Now, Vega curve changes with time. We were saying time was fixed before. Now, you can see how as the time changes, the curves change. Really what this means is as time gets closer and closer to expiration, it pulls these curves, both positive and negative, in closer to at the money. And it has more effects closer to at the money on either side of it, both positive and negative. That's the real takeaway from this. So as time changes, you see when it's 60 minutes to go, further out of the money, implied volatility has more effect. And further in the money, it has more effect. As we get down to 5 minutes, you have to be closer to the at the money strike price on either side for it to have the effect. This is, again, we have to show these graphs with only moving really one variable at a time, but then I'm showing you graph after graph after graph that if you change a different component, it's going to change the curves still. It's going to change how these things affect. That's why it's sort of like a 3D puzzle. All right, so even volatility affects your Vega curves, and it does it similar to time. So you see as the implied volatility is up, it moves this farther away. The effects out of the money and deep in the money are greater. As you get lower and lower volatility, it brings it closer to at the money, and it has more effect really when you're on either side, whether you're just out of the money or whether you're just in the money. Here's your time and volatility. So you can see roughly how it pulls it in on both sides. Less time is the same as lower volatility. More time is the same as higher volatility. You can roughly see that. They're not going to be exact, but just remember the rule of thumb. So, Bob, do you want to jump in here? Okay, not hearing Bob, so I'll just go. You may need to review this information multiple times.
It's not necessary.
Very good.
It's not necessary for you to continue because I couldn't turn my microphone on.
Well, hey, you know, it was tag team. It was, yeah, I didn't tag you in right.
Yeah, tag team can be taken good or bad. So
I know, hey, I was wrestling move. It was a wrestling term.
All right, you may need to review this information multiple times. It's not necessary that you worry about the absolute value of the Greeks. This is a big thing. We get this question all the time, guys, where people will say, well, how do I know what the volatility is, or how do I know what the delta exactly is? And it's not important that you know that at this time. It's more important that you grasp the concepts. So it's not necessary that you worry about the absolute value of the Greeks while trading the Nadex binary option, just that you understand how changes in price, time, and volatility can affect your Nadex binary option position. We needed to provide all this information so you would have a solid foundation in understanding the Greeks as applied to Nadex binary options. This will prepare you when we elaborate on specific binary option entries and exits based on various market conditions, trade durations, and volatilities. That's the important part. Again, down the road, we're probably going to have something for you guys to be able to actually see the numbers, and then you could watch them change on a tool as opposed to rather just watching the price. But this, again, there's no substitute for time in the chair, and you have to kind of watch and see if I'm in a trade and not a lot of time has passed and the price has dropped and the market hasn't moved, it seems like volatility might be going down. You can make these assumptions, and you can get used to sort of the concepts of the Greeks. That's just one. In this webinar, we reviewed the concept of delta and gamma and then introduced the concept of theta and vega. We examined how price, time, and volatility changes affect theta and vega and how they also affect the Nadex binary option price. All this will play into how, when, and where a trader puts on a binary position. This will give you an inside track to establishing Nadex binary option positions that are specifically aligned with different trading strategies and designed to successfully capture certain market events. We're not trying to take away the simplicity of the binary option, especially, again, you guys have to remember the only place to trade binary options, in our opinion, is Nadex, because they're regulated by the same people who regulate the CME group and the other major exchanges. So this is the only place to do it. And because they have the option of you exiting the trade early, okay, you have to take the trading part of this a lot more seriously. Yes, it is a simple yes or no opinion that you place into the market, but there are times to put that opinion on that are better than others. And that's the thing you have to learn if you actually want to do this repeatedly and be a high probability trader and succeed with a certain amount of consistency. So again, we are Path Trading Partners. We would love it if you would follow us on Twitter, like us on Facebook, and go to our website. Sign up at our website because there's a lot of free stuff you guys can just take and study and read. There's blogs, and there's also our podcast, the Money Path Podcast. All the blog articles that we write for Nadex and others are all on there. And again, there's a lot of free stuff for you guys to look at there. So my preference is you sign up for the Money Pad podcast and sign up for Path Trading Partners. Just go through the free stuff. If you decide you want to do anything more than that, we'd love to have you. If not, we'd love to answer any questions you have right now. Otherwise, we'd love it if you guys would go grab dinner with your loved ones and just leave each other alone. Be good to each other. I don't know. What do you got, guys? Anything? As of right now, I'm not seeing any questions. I'll wait a few more minutes, and if not, I'll turn it back over to Nadex to end this webinar. Again, go to Nadex, you go to the Webinars tab, and then you go down to Archives, and that's that. You'll find us there. All right, guys, I'm not seeing any questions. If I'm cutting somebody off that has questions, you could, again, go ahead and send the questions to the Contact Us form on our website, or you could send them to Nadex staff and they'll get them to us. Again, visit us on the website, sign up, and we will catch you guys next Tuesday at the same time. Cheers, everybody. Thanks to Nadex, and we'll talk to you guys next week.